Good morning. Here is today's Korean economic news briefing. The Korean economy is navigating through increasingly turbulent waters, primarily driven by escalating geopolitical tensions in the Middle East and their profound ripple effects across global energy markets and supply chains. This morning, we will delve into the government's swift responses, the anxieties gripping domestic industries, and the shifting dynamics in our financial and real estate markets. First, let's address the critical issue of the Middle East situation. The U.S.-Iran conflict has led to significant volatility in the foreign exchange market, prompting an urgent response from the government and ruling party. They have announced plans to expedite legislation, including a proposed FX stabilization law. A key component of this initiative is a measure to alleviate the capital gains tax burden on overseas stock investments. The aim here is twofold: to encourage the inflow of foreign currency and reduce outflows, thereby bolstering the Korean won amidst the current instability. This proactive stance underscores the government's determination to shield the domestic economy from external shocks. Adding to the government's immediate concerns is the threat of profiteering from the rising oil prices. Deputy Prime Minister and Minister of Economy and Finance, Gu Yoon-chol, issued a strong warning to the oil industry, stating that profiteering using the national crisis situation will not be tolerated. He emphasized a zero-tolerance policy against any legal violations, signaling a firm hand against those who might exploit the current climate for excessive gains. This move is crucial to protect consumers from runaway inflation and maintain public trust during this period of heightened economic uncertainty. Indeed, the Middle East crisis poses an immediate and significant cost shock to Korean industries. With the Strait of Hormuz, a critical choke point through which 20% of the world's crude oil passes, facing potential disruptions, the industrial sector is on high alert. Industry leaders are bracing for surging raw material costs and logistical nightmares. This concern is not unfounded. International crude oil prices, particularly WTI, have already surged past $80 a barrel, and LNG prices have more than doubled in just a week. Compounding this, tanker freight rates have skyrocketed, with daily shipping costs doubling to around 600 million won. This dramatic increase in logistics expenses is causing panic across the global supply chain and directly hitting Korea's export-dependent economy with a cost bomb. The sustained conflict in the Middle East also casts a shadow over Korea's hard-won current account surplus. While the nation has enjoyed a robust surplus driven by strong semiconductor exports and a previous dip in raw material prices, the rising oil and energy costs, coupled with escalating freight rates, threaten to reverse this positive trend. The Bank of Korea is closely monitoring the impact on imports, acknowledging the significant volatility introduced by potential blockades in the Strait of Hormuz. This could inevitably lead to a deterioration in the goods balance, a critical component of the current account. On the macroeconomic front, fears of stagflation, a grim combination of high inflation and low growth, are growing. Some analysts are even projecting oil prices could reach $150 a barrel. This presents a complex dilemma for monetary policymakers. Typically, soaring inflation calls for interest rate hikes, but simultaneous warnings of slowing growth caution against such tightening. We are already seeing signs of this tension, with Korea's 3-year Treasury bond yield closely tracking the 10-year yield, indicating a flattening yield curve that often precedes economic slowdowns. This domestic challenge is mirrored internationally. Recent U.S. employment data showed an unexpected decline of 92,000 jobs, intensifying fears of a looming recession. This has led to a near certainty of a Federal Open Market Committee (FOMC) rate freeze in March and April. However, the simultaneous surge in energy prices complicates the Federal Reserve's calculus, presenting a difficult balancing act between stimulating growth and taming inflation. While some Fed officials, like Governor Christopher Waller, have suggested the Iran conflict might not have a sustained impact on inflation, the immediate pressures are undeniable, creating a precarious global economic environment that Korea, with its high oil dependency, finds particularly vulnerable to. Turning to the financial markets, the Korean stock market, or KOSPI, has been on a roller coaster ride, exhibiting historic volatility in the wake of the Iran-US tensions. While some analysts suggest the market may have already pre-reflected the worst-case scenario and found a technical and psychological bottom, the extreme fluctuations highlight deep-seated investor anxieties. The rapid market movements have also led to significant discrepancies between exchange-traded fund (ETF) prices and their underlying net asset values, making real-time pricing challenging for investors. Despite the instability, a notable trend has emerged: A surge in margin loans for stock investments, with over 1.3 trillion won increased in just 3 days following the Iran conflict. This indicates a segment of investors is seeking opportunities even in turbulent times, though it also points to increased risk appetite. Globally, U.S. Treasury bonds, typically seen as a safe haven, have seen yields rise due to increased issuance, reflecting the dual pressures of funding wartime expenditures and attracting investors during uncertainty. In the industrial sector, Korean companies are demonstrating resilience and foresight. There's a notable push towards securing critical minerals, with initiatives to extract key semiconductor and defense materials, like indium and antimony, from discarded metals. This strategy, alongside expanding into EV battery materials and strategic mineral refining, is aimed at reducing external dependency and enhancing supply chain stability, a critical move given current geopolitical disruptions. The K-battery industry, despite facing headwinds from a global slowdown in EV sales, as seen with SK On's layoffs in the US, is also expanding its horizons into AI infrastructure, energy storage systems, robotics, and defense, showcasing its adaptability. The rise of AI is a significant driver for future industrial growth. HD Hyundai Electric is building a second transformer factory in the US, anticipating a surge in electricity demand from expanding AI data centers in North America. Traditional heavy industries, like the HDC Group, are also committing substantial investments in AI and robotics to transcend their conventional roles as construction companies. Meanwhile, major tech players like Naver and Kakao are pursuing distinct AI strategies, with Naver focusing on real-world AI beneficiaries for quicker results, and Kakao on option-type AI beneficiaries for long-term growth potential. Lastly, on the domestic front, a major structural shift is underway in the real estate market. Seoul's apartment rental market is rapidly transitioning from jeonse to wholesale monthly rent. The average monthly rent for a Seoul apartment has now exceeded 1.5 million won, marking an all-time high. This phenomenon is largely driven by the aftermath of jeonse scams, stricter requirements for jeonse loans, and the government's June 27 loan regulations that prohibited conditional jeonse loans for new apartments. As a result, new apartments in Seoul are seeing wholesale contracts making up as much as 60% of total rental agreements, placing a growing burden on tenants. This fundamental change in the housing market will have far-reaching implications for household finances and broader consumption patterns. In summary, the Korean economy is currently facing a confluence of external geopolitical risks emanating from the Middle East, leading to significant inflationary pressures and supply chain disruptions. Domestically, while industries are pursuing long-term resilience through strategic resource development and AI integration, structural shifts in the real estate market are adding to household financial burdens. For investors, this period calls for heightened vigilance and a cautious approach. Geopolitical instability is likely to fuel continued market volatility, making careful asset allocation and diversification more critical than ever. While market downturns can present opportunities, the current environment also carries significant risks. For general viewers, the immediate implications are primarily centered on the rising cost of living. Higher energy prices will translate into increased costs for daily necessities and transportation. The shift in the rental market also means higher housing expenses for many. It is crucial to stay informed about government measures aimed at stabilizing prices and supporting livelihoods during these challenging times. That concludes today's economic news briefing. Thank you for joining us.